Okay, hey, good morning. Thanks everybody for joining us today. Another episode of the Hanson Capital Group Industrial Education Webinar Series. If you notice, I've got a little bit of a squinty eye. I've determined yesterday I've gotten my first sty, so apologize for that, but they said it'll be cleared up quickly. Format, if this is the first time you've had the opportunity to join us, we've got Ted Ost, our Managing Director of Investor Relations, as well as Chris Pike, our Managing Director of Acquisitions. Ted will moderate us as we work through some content, not a lot of slides. I think we have 8 slides today. We want to go over specifically the Scottsdale investment opportunity that we've got open right now. We find that this works a lot better when we've got interaction and engagement. We'll have Q&A at the end, but please feel free to use the comment section and ask questions as we go. We'd much rather interact and answer things as we go than just spout off information at you. With that, I'll hand it to Chris Pike.
Sweet. I'll give you a quick background on the company. So Hanson Capital was established back in 2008, started in the residential space. Chris Hanson was buying single-family homes at auctions and packaging them into portfolios that he was selling to institutions, as well as had a service business of buying single-family homes on behalf of institutions at the auctions. Also did a significant amount of existing value-add apartment deals. Between both single-family homes and apartment deals, did a few thousand residential doors bought and sold across the Sun Belt. We didn't start acquiring industrial assets until 2018 and picked up the pace in the industrial space in 2021. At the time, we were focused on buying industrial outdoor storage assets as covered land plays. And throughout 2021 to date is what's built our existing portfolio today. We've exited a large portion of those industrial outdoor storage assets. And today our focus is on small bay multi-tenant industrial assets. Today, we're going to walk you through, as Chris mentioned, our latest opportunity, the Scottsdale Small Bay portfolio, which is 2 small bay assets in North Scottsdale at the Scottsdale Airpark. And we'll walk you through why we love the submarket, how we underwrote rents, and dive into the business plan, as well as address any questions that you guys may have as we're walking through it. With that, I'll let Ted step in with a quick disclaimer.
So the information shared today is for informational purposes only and does not constitute an offer to sell securities or a solicitation to invest. So any potential returns discussed are not guaranteed and depend on the company's ability to execute strategy as outlined in its private placement memorandum. So please conduct your own due diligence before making any investment decisions. Also, you'll notice there's a Q&A tab, so please feel free if you have any questions or anything, go ahead and add it in there. It always helps these presentations as we get audience interaction. So if anything comes to mind, please feel free to throw it in the Q&A. Then afterwards, we're happy to discuss one-on-one as well. So if there's anything that comes up that we don't get to, or you'd like to discuss this opportunity in person, we will be sure to make time for you. Hanson, you want to talk about why we're looking at the Scottsdale Airpark right now?
Sure. Scottsdale Airpark is the lowest vacancy in the Phoenix Metro. There's only 14 million square feet in the Scottsdale Airpark. And to put that in perspective, there's just over 500 million square feet of industrial in the Phoenix Metro area. So it's a little under 3% of the total inventory. There is no room to build. The last parcel that was sold of meaningful scale was over $100 a foot near the Scottsdale Airport. Land cost plus entitlements, even if you could find a big enough piece, it would be difficult. And there is significant large tenant demand up there, is continuing to drive for it, but the Scottsdale municipality has communicated a not interest in further industrial development.
Of the 14 million square feet of total inventory, Pike, can you talk about why that matters for the properties that we're acquiring?
So it's extremely limited supply in general. Chris mentioned it's one of the tightest submarkets in the Phoenix Metro. You compare it larger submarkets with more significant industrial supply, like the Southwest Valley has 208 million square feet. The Southeast Valley has roughly 110 million square feet. So 14 million square feet is a very tight supply, and it's in a premium location that has strong tenant demand that wants to be near affluent residential. You get a lot of business owners that want to be close to home or have their business close to home, or you've got a lot of service style industrial tenants that want to be close to that affluent residential growth. So it's a premium submarket with an extremely tight supply. So that's what leads us to be very much so insulated from a supply demand standpoint.
Is there any new supply of small bay coming to the submarket, Hanson, that you're seeing?
There's 2 projects under construction in Scottsdale that are largely thought to be the last industrial projects. There's the Mac Innovation Park. These are both over near the 101 Loop, and that's being demised down as small as 20,000 square feet. And the other one, the Loop project, is only being demised down to 27,000 square feet. So in the niche that we're focused on, I think our average on these projects is about 3,000 feet. There's no new supply coming online in that sector, and it would be economically prohibitive to build that. You'd have to build too low density of a project, hence the newer projects being much larger in size.
Mike, how does this submarket compare to where the big box oversupply is happening in Phoenix?
So I touched on like total supply numbers, but from like a vacancy standpoint, you can see on the slide, the Phoenix Metro in general is at 12.4% versus the Northeast Valley where Scottsdale is located is at 6.3%. If you're looking more specifically, like at the Southwest Valley, they're hovering around 14% today. The Southeast Valley is hovering around a 15% vacancy today. And that's being caused by the fact that both of these submarkets were glut of the new big box supply that has been developed in recent years. That's having slower demand and a little bit slightly slower lease up and oversupply issues versus the Northeast Valley or Scottsdale. We're at 6.3%, which again, due to the reasons Hanson covered of landlocked, not allowing much new industrial development, we're in the tightest submarket in Phoenix Metro and Scottsdale.
And Pike, to expand on that, if you think about people who have an industrial use in North Scottsdale, if you're service related, those vendors that are actually servicing the rooftops in that area, that's the closest they can be. So those guys need to be there, and it's probably worth it for the proximity. The other user there is somebody who lives in the North Scottsdale or Paradise Valley area who doesn't feel like driving to the Southwest Valley for work, maybe smaller manufacturing or things like that. And again, these guys are happy and willing to pay a premium to be in that area, whereas that overall vacancy picture, you were just relaying the 15% in the Southeast and the 14% in the Southwest. That doesn't tell the whole story. That is large product that's vacant. This smaller product, our average of 3,000 feet per bay, that might as well be like retail and office in terms of are they the same thing? Because they're meeting completely different needs. So we've got a product that's irreplaceable in an area where, one, there's no dirt, but even if there was dirt, you wouldn't be able to build more of it at this low density type. That's why we're excited about the project.
Mike, can you talk a little bit about what we're actually buying in the two properties?
Sure. No, go for it.
Go for it.
Cool. We're buying two separate business parks. Combined, it totals just under 90,000 square feet. The one on the left is currently titled the Broadway High-Tech Business Park. The one on the right that you're seeing on the screen is the Cornwall Business Center. Broadway High-Tech, just under 50,000 square feet. The Cornwall Business Center is just over 40,000 square feet. Very similar product. The Cornwall Business Center has slightly smaller bays, averaging around 2,000 square feet. And then the Broadway High-Tech building on the left has a few larger bays, but the average bay size is hovering between 3,000 and 6,000 square feet for a bulk of the inventory there. So very similar product type, identical submarkets. Really the main difference between the two is just vintage, with Broadway High-Tech being slightly newer.
And then can you talk about the leases and what's the vacancy look like on each property, Pike?
Today, the Broadway High-Tech building is 100% occupied. The second park, Cornwall Business Center, is at 93% occupancy. That building has a tenant that's vacating due to non-renewal, but we already have a neighboring tenant who's interested in taking over the vacancy. As soon as we close on the asset, we're going to be able to step in and have the conversation directly with the tenant. But there is strong demand. So historically, this building has seen strong occupancy because the owner's been more focused on maintaining occupancy rather than keeping up with market rents. So we have strong current occupancy, but the one vacant bay is going to be a great opportunity for us to start implementing the execution of the business plan of pushing the park to market rents.
And like those bays, as we've talked about on our webinars time and time again, when they're more educational focused, the ownership here built and developed this property. So this is the play where we have something where it's got deferred maintenance. It's got opportunity to bring these rents up to the market rent because the rents have moved so quickly. And the owners having 20+ tenure of ownership here, 30 years in one case, they're not staying current with all that, which makes really low hanging fruit for us to go create opportunity.
Well, it's about 90,000 square feet, 30 bays, average about 2,900 square feet. So what types of tenants do you have occupying these spaces, Hanson? What do you see in these units?
So across those 30 bays, I think it's like 23 tenants today because some of them have more than one bay. It's a pretty good mix of the small contractors, service businesses. There's some small light manufacturing. We've got some equipment storage. There's staging companies, but it's mainly fixated on some local trades with a little bit of a retail component from some of them.
I think the thing that's unique about Scottsdale as a submarket in general, due to the premium location and the affluent residential growth, you get some users that are a little bit more higher end than some of our other truly pure service industrial style tenant focused buildings, like buildings we're buying in Houston, where you get a lot of the heavier uses or the contractor style uses. You still get people that are interested in these types of buildings, but we're also getting some higher. There's a blind company who is selling blinds, but in the front they have a showroom set up as well, right? So it's easy access. Like they're a contractor that's servicing the residential growth, but instead of using the front space as an office, they're using it as a showroom. So they have a place for their clients to come in and look at different options of blinds, right?
Which they wouldn't want to move and leave the airpark. They're catering to this submarket with a retail showroom that's also allowing them to manufacture and operate a contracting business.
So you get some higher end uses that you don't always see in other parts of the metro, for sure.
I was here about an hour ago, and there's a guy that's selling custom putters that cost anywhere between $700 and $1,200. So he's got a fitting room up front, and he manufactures in the back. So Hanson, why are we buying these as a portfolio rather than individually?
Well, when we can get a seller to sell us something off market, we're always excited. We actually started pursuing the Broadway High Tech building, the one on 82nd and Hartford, over 3 years ago. And we had a purchase contract signed on our side that the seller didn't sign. He decided he wasn't ready to sell. When we got him back to the table to sell, he threw in the other building this time. So anytime we can get things and we can get a bigger footprint, we love it. In this case, 30 bays across 2 different parks and 4 buildings. That adds diversification within a single investment while still being very easy to manage. We have a couple other buildings we already own right up in the Scottsdale Airpark in between these 2 properties. So this will make 4 buildings that we've got in that area, just adding to the efficiency.
Pike, how does this get structured for investors? They're split and they're into 2 standalone deals. Just chat a little bit about how that works for the investors.
I think to clarify why we're mentioning it's 2 standalone deals, we're also investing with internal 1031 capital. In order to facilitate the 1031 capital, we had to structure them as 2 deals, but anyone who's investing through our Fund 3 investment will be investing as a single investment that's split pro rata across both assets. So anyone that's listening to this, investment would be split pro rata as a single investment into both of these assets.
Perfect. The thesis here is the rent spread. Hanson, could you walk us through the spread, what it means, and why it's attractive to us?
Again, if you've been to any of our educational webinars, this is what we talk about all the time. There's no reliance on the market movement or anything like that. For our current underwritten rents, we're underwriting to go to $1.85 across the 30 bays today. We have $1.12 in place. So we're growing the rents approximately 65% from what's in place today to where we plan to take them. And I think it's worth noting that we believe that we hope this gets achieved. We're looking at the actual rents that are getting achieved, and there's a range here that we're relying on, and we're erring to the low side of that.
And Pike, where does $1.85 come from for the market?
So that's touching on what Hanson mentioned. So just like any other project, we go out and look at lease comps through a variety of sources, through CoStar, direct research online, through conversations with local brokers that have active listings in the area, that are working with tenants in the area and what they're seeing. And today in the market for product that's been improved, where they've done some exterior improvements and turning the bays and doing some light interior bays, and sometimes they're not even doing the interior improvements, we're seeing rents getting signed anywhere in the $1.75 to $2.10 a square foot range. So I think it's important to reiterate what Chris mentioned is, hey, our rents at $1.85, not only is that today's rents, but that's on the low end of what we're seeing being achieved in the submarket today. Again, with those rent spreads being anywhere from $1.75 to $2.10 a square foot for improved product in the market.
70% of the rent rolls in 30 months. Is that a good thing or a risk, Hanson?
70% is great. The Other ends of the extremes, if it was 100% rolling in the next 30 months, is that more risk? It depends on how you assess that. 65% lift from in-place rents to market rents is not a small lift, so that's a good opportunity. At the same time, we've got to recognize that when somebody's rent is going from $1 to $1.85, there could be pressure that puts on them. So we don't want to fail to recognize that it's not an insignificant rent lift that we're looking for, but we'll rely on the fact that they're 100% and 97% occupied, and that we're seeing those comps get done north of $2, that it's not an unrealistic lift. So I think it's a great thing. If it were 100% of the portfolio rolling, would I be more excited? Yes, but I'll also say something we've learned over the last 20 years is when we leave a little meat on the bone and there's still opportunity for the next guy to make some money, buyers will frequently overpay for that. We see that time and time again. You'll see a stabilized product sell at, say, a 5.5 cap, but a project where you'd have to go put millions of investment in and a couple of years of work might sell at a 4.5 cap, and we'll go play with realistic numbers of how much money we'd have to put in, and we can't achieve that 5.5 that they're underwriting. So the inefficiency or optimistic nature that buyers sometimes apply to these deals, I like that we're not able to achieve 100% of it, because that leaves that opportunity for the next guy, or that carrot to dangle to see if he thinks he can do better. And again, that's assuming we sell in 3 years, not as part of an assembled portfolio or something like that.
And I think another thing that's important to note, or that's unique about this opportunity, is a lot of these deals where we're buying off market from a private capital seller on these multi-tenant small bay business parks, the average lease term that's in place is very short. Sometimes it's only a year and a half, or sometimes even less than a year, because they've got a lot of month-to-month tenancy. This one's somewhat unique where, again, it takes us 3 years to execute the business plan, and we're still not even hitting 100% of the rent roll in those 3 years. And that's because the current rent roll is pretty well diversified from a lease termination date or a lease end date standpoint. So that is a positive in the fact of, hey, we might not get to hit all the leases in year one, but it does provide consistent cash flow and phased unit turns. So as we turn bays, it provides a little bit more stability and cash flow over the whole period. So I think that's a unique item to note for this specific deal.
When you're increasing rents by 65%, some of the tenants would probably push back. Like, how do you handle that?
So it's a conversation to be had, right? Like ideally we phase in the improvements where we're running exterior improvements at the park before we're going and having a majority of these conversations. So tenancy improved. They understand why they're starting to pay more rent through physical improvements that they can see and touch, that the customers see. So right, we're creating some value proposition before we go have these conversations. But then when we have these conversations, the linchpin is, hey, go look out in the market and see what else is out there. They're going to go see, for any similarly improved product, $1.75 to $2.10 a square foot. If we're offering them $1.85 a square foot, where they aren't going to find anywhere that's necessarily cheaper. And if they do move somewhere, they have to account for the cost of moving. So 9 times out of the 10, it makes more sense for them just to stay where they're at rather than moving across town to pay the same rent that they need to pay. Again, as Chris mentioned, we understand that is a big spread, and inevitably there are some people who can't afford that or bear that cost increase, but we're underwriting accordingly for renewal ratios that account for that potential vacancy as people turn on units that have a larger rent spread.
Hanson, are there tenants with below market renewal options? And if so, how do you handle them?
Yes, there are certain leases in place at this property, amongst most properties, where the tenant has a lease duration, and then at that end of that duration, there's an option. And in that case, it's what I spoke to earlier about, if it's below market, the odds of that being renewed again is pretty high, because it's in the tenant's side of the decision to decide, I want to keep this lease rate in place. But again, it's an opportunity for the next buyer, because they know they've got some built-in upside, and it's something that people will frequently overpay for. So I think there's only 2 tenants in that scenario where the rents are way below market and they've got some extended duration. And I believe that'll show up as opportunity for the next guy.
Anything to add there, Pike?
No, man. I think we've got it covered.
Perfect. Let's go into the business plan here. So walk us through the capital plan, Pike. Where's the $1.2 million going that we have set aside?
So we see the most value being derived from running those exterior improvements that I mentioned, and specifically exterior paint, cleaning up the landscaping, completing a asphalt seal and stripe, making sure that the property presents its best, as well as in one of the two properties, we can update the signage. Scottsdale does have some restrictions around signage, but we will improve signage as well. And so really upgrading the exterior presentation of the property. In addition, when we're turning units, we're going to come in and do the typical white boxing the warehouse. We're painting and replacing lighting as needed. Going into the office spaces, doing new LVT flooring, replacing ceiling tiles and lighting, repainting, etc. Just giving a very clean, move-in ready space. In addition to that, in our due diligence process, we discovered that both properties need a roof overlay, and as well as a good chunk of the HVAC units are towards the end of their useful lifespan. So we got the seller to credit us a significant pricing discount to accommodate those capital improvements as well.
So Hanson, why do exterior improvements matter? Is it about like curb appeal? Is it something else? What do you think? What's your thoughts there?
When you fix and flip a house, which everybody's familiar with, that curb appeal or the first impression, the basic aesthetics is always going to make a lasting impression. So I think it's critical up here when we're talking about industrial property with vinyl tile floors and empty warehouse. There's not a whole lot of differentiation you can make, but given the vintage and that these properties are older, there's not a lot of new product to compete. We think it's worthwhile spending money on those very basic things that Chris Pike just outlined, because we are up in Scottsdale, so the expectations are a little bit higher. And when you've got a nicer aesthetic, when people drive by or walk up to it, people feel better about that, and it's proven that commands a higher rent.
We talk about white box warehouse finishes sometimes. What does a tenant see when they walk into one of these properties when you use that type of verbiage?
And I use that verbiage consistently, but understand that's probably not super clear to everyone. Coming in, white boxing is generally what it sounds. Coming into the warehouse and making it present extremely well through simple improvements like paint and lighting upgrades. As Chris mentioned, there's not a ton that you need to do in the actual warehouse itself. Occasionally, you may need to grind and seal the concrete flooring if it's damaged or there's some major issues there. But white boxing is just a term that's used to say a very clean presentation, which typically just includes painting and improving lighting.
Move-in ready, Hanson. So how does that help with lease up and rent achievement when you provide that to them?
This is really just a function of when you're talking about 20, 50, 100,000 square feet, we're talking about bigger, more mature businesses that are planning way ahead. And when you're talking about a 3,000 foot space, having it turnkey and ready to go is where they can walk up, they can see it, and we can put a lease in front of them and get it signed within a couple days. These are generally tenants that are going to be moving quicker on shorter time frame. Maybe their lease is up wherever they are at the end of the month and they're touring mid-month. So if there's anything we can do to reduce the friction, reduce the decision time, and get a top of market rent, it's having everything already ready to go. And then a side benefit of that is it eliminates or minimizes the discussion or negotiation on TI allowances. Because if something's already done in tip-top shape, we're not debating, what color vinyl do you want? So it allows us to keep our product consistent. And that in turn gives us better pricing efficiency because we know we've got 90,000 feet. We know how many feet of that we're going to redo the flooring, and we can buy that efficiently as we go.
Like when you're doing this, do you improve everything all at once, or do you do it over time? What's the sequencing behind how you guys operate?
It goes into the conversation that we talked about how we approach the renewals in terms of sequencing the improvements. You want to focus on exterior improvements first, as I mentioned. When you're working through renewal conversations with the existing tenant base, it makes those conversations go much smoother because you see the tenant has tangible improvements that make that renewal conversation a little bit easier. And then depending on the rent roll, right, as we see tenants turn, if they do not renew, then we will go through and execute the interior make ready. For the CapEx planning, we will move forward with doing things like the roof overlay right away because it seems like that needs to be done based on our initial due diligence. But things like the HVAC units, typically we did get a credit to replace those, but historically we'll just operate in the manner of replacing those as they fail. So not necessarily all the capital deployed up front. We're very much so focused on doing the exterior and the facade improvements right away to help with those renewal conversations, and then phase in the unit turns as people decide, if and when people decide not to renew at the termination of their existing leases.
Perfect. But let's go through the numbers a little bit. Hanson, purchase price, equity, blended basis. If you could talk about that a little bit, that'd be helpful.
We're paying combined $21.6 million. Pretty light overall lift, only a little over $1.2 million. We're going to put up $10 million, $10.4 million. And I think what we're most excited about is the just blended purchase price. We're in at $241 a foot. We have not seen a trade in the Scottsdale Airpark near that pricing for some time.
Pike, talk a little bit about the replacement costs for the Airpark and maybe some recent sales comps that you and your team have seen.
In terms of recent sale comps, majority of product that's selling in the Scottsdale Airpark is selling north of $300 a square foot. Comps are ranging in the 266 a square foot up to the mid to high 300s a square foot, depending on product type. But a bulk of inventory in Scottsdale Airpark is trading in the 320 to 360 a square foot range. So buying at $240 a square foot is well below market. And then from a replacement standpoint, as Chris mentioned, it's really difficult to replace this product type because there's limited land available to actually develop it. So one can't really find the land to develop this product on. And even if you could, it's not going to be accretive because land prices are easily going to be $60 to $100 a square foot, right? Like it depends on the parcel, right? Some of them are abutting, some of that higher end price per foot dirt is abutting the airport. But again, even if you're on the lower end of that range, $50, $60 a square foot, if you have a 50% coverage ratio, you're already into just the dirt at north of $100 a land square foot or $100 a square foot on the building. And then you start accounting for the cost to build it. You're getting well north of $300 a square foot, pushing into the $400 a square foot range on replacement cost. But again, that's even if you can find the dirt to build it in this submarket.
Hanson, can you talk to us a little bit about the debt structure?
Almost 2 decades being First Bank was acquired by PNC earlier this year. They're going to do a 5-year fixed deal for us, 6%. The fixed rate, there is certainly a lot of rate uncertainty right now, and it seems like most of the Fed believes we're going to be raising rates at this point. So we're doing a 5-year deal at 60% because that's a conservative leverage. We're planning for a 3-year hold, but that gives us 2 more years of cushion in case any surprises come up. Pretty basic down the fairway loan on this one.
Did have a question from the audience. So from the project summary, I understand correctly that this is a 3-year hold, and upon sale of the assets, will funds be distributed upon asset sale or rolled over as a 1031?
I can jump in there. So ideally, we're as a company, we're net holders of real estate, so we're always going to look for an opportunity to 1031 exchange an asset, but we're not going to force a exchange if we can't find the right opportunity, right? We're not going to force an exchange just to avoid paying taxes. So if the right opportunity arises and the timing lines up to execute a 1031 exchange, we will look at executing a 1031 exchange and dragging all partners alongside with us. If upon execution of that 1031 exchange, majority of our partners, typically, if we do what we say we're going to do and do a good job, majority of partners say, hey, I want to keep our money working. But for those that raise their hand and say, hey, if there's an opportunity to be recapitalized, we'll go out and look at options for recapitalizing those people. In addition, I think the only thing to add to that would be we are limited by our fund life. The Fund 3 is a 10-year sunset provision on it. So we have a 10-year fund life that would prevent us from continuing to 1031 exchange at the close of the fund.
Mike, can you talk a little bit about the IRR and some of the key assumptions and the sensitivity that you see you're running? And then we did have another question you can incorporate into that. Have you sensitized the returns if rents aren't achieved, and what is the sale value cap that your IRR is based on?
So again, the key drivers of that return is capturing that rent spread of the moving existing rents to $1.85 a square foot underwritten rents. In terms of how we sensitivity analysis on that, right, we look at, we're not applying rent growth assumptions to this. We're not trending rents by 5% a year over year. To get to that, we're underwriting to today's market rents and at the low end of today's market rents. In addition to that, we also looked at it from a scenario of, okay, at the end of the business plan, if rents go down or the market softens for one reason or another, what do we do? And give ourselves some options on a refinance. And we stressed rents down it was $1.45 or $1.55 a square foot. I have to pull up the spreadsheet. I haven't looked at it in 3 days roughly, but we had significant room before we ran into trouble on having to execute a refinance at the end of year 5 if we were unable to hit the rents that we're talking about in rents compressed significantly versus where the market's at today. The other factor in terms of hitting our underwritten returns is obviously executing the construction on budget. The construction numbers that we're utilizing are hard numbers that we've gotten from a general contractor who walked all of the bays they brought in their subs and walked all the bays that we're looking at turning throughout the hold period and gave us hard quotes on those bays. And then we also added a 20% contingency on the numbers that they gave us, right? So again, we're confident in our construction numbers and based on what was provided to us by our general contractor who's been inside the suites. And then the third piece is hitting our exit assumptions on a sale price or sale cap standpoint. And then in terms of how we're getting to that, we generally triangulate the value between a couple of factors, right? Because these small bay deals trade at a variety of cap rates depending on how stabilized the deals are. We're looking at a few different things, not just what other properties are selling for from a cap rate standpoint, but also what does the exit basis look like, and making sure that the basis we're underwriting for the sale is achievable in today's market. So we backed into our exit assumptions, not only from a cap rate standpoint, but from a basis standpoint. And if for any reason we're unable to achieve that at the end of our hold period, we're very comfortable with holding this asset based on the stabilized return on cost that we're achieving.
Before we move on, Hanson, can you hit on the equity multiple real quick and how investors should think about that on a 3-year hold?
Sure. IRR is sometimes confusing because it factors in the net present value of the future cash flows. Equity multiple is probably the simplest way to compare one deal to another. In this case, 1.55 means over that 3 years, for every 100,000 you put up, you would expect to get 155,000 back. So total return across the period is 155% of what's been deployed. Very easy metric.
Okay, so risk mitigation and exit strategy. So Pike, what are the risks on this deal?
So I touched on those in my last response, but you're really looking at execution of the renewals or replacement of the tenants upon rollover. The other risk would be, hey, what happens if market rents soften? Or third being execution of the capital improvements and if the scope changes for those capital improvements, or cap rate expansions due to market shifts that are out of our control. Those are really the main, or renewal options, right? I touched on that in terms of market rents and whether or not having those below market rate renewal options that Hanson mentioned as well. Those are really the risk factors.
Let's hit each of those individually, just risk expanded, and then how we're mitigating for it. Because you named 5 there, Chris. I'll speak first to that lease rollover risk or the actual execution. We talked about before the 70% that's going to roll in the 30 months. Risk there is what if somebody leaves and a bay sits vacant? With 30 total bays, we've got effectively 3.5% of our exposure on any bay. And when the total submarket's at 6% vacant, and that is not accounting for purely the small bay. The small bay is actually going to be a little bit lower than that, along with the really strong demand in the airpark. We don't think that's the real risk. This is not some outskirt declining population area. This is North Scottsdale, the most premium industrial submarket in the state of Arizona. So lease rollover risk is probably the least of our risk concerns here.
And then I'll jump in on market rents and what happens if the rents soften. I generally already answered that question. I was probably a little over elaborative on the last slide, but the market rent soften, we're already hedging against that in how we're underwriting today, right? We're not targeting top of market rents, and if we see a decline, we're underwriting the low end of what's being achieved in the market today. So we're hedging that with the way we're underwriting, as well as our acquisition basis helps provide a hedge against that. And then the other hedge against that is no new supply. Like, it's a lot of the stuff we talked about at the start of the slideshow was, hey, we're in a very supply constrained submarket. There's only 14 million square feet of industrial product. So it's already a tiny market with a significant amount of demand. So we've got a lot of the macroeconomic or general submarket.
The other one you mentioned was the execution of the capital plan or the construction. General contracting partner. We've done a number of deals over a number of years with this particular partner. They have been our go-to contractor. Each trade involved, they will bid multiple trades, and if we don't like the pricing, we bring our own trades in. We have all of our own trades in virtually every sector ourselves. Chris mentioned earlier, we have a 20% contingency, and that's in addition to the roughly 20 guys we walk through every bay at these properties. So we have a comprehensive hard bid in hand. The variance in that is if we don't touch one of these for 3 years, materials could change. That's why we put an additional contingency in there. A hard bid, meaning if we signed it today, not a hard bid for 3 years from today price. But again, we're talking about paint, LED lights, and vinyl flooring. It's just not, the construction risk is, again, fairly minimal here. And I'll just keep hitting these Pike to work us through them. The debt risk, I already talked about. We do not see debt risk with having a 2-year target. We can hold and continue collecting cash flow. We mentioned the stabilized yield is in the 7s. In year 4, it jumps to like a 7.8. In year 5, it's north of an 8. And when Chris mentioned, we did a stress test of what if the market rents went down 20, 30, and 40%, where do we run into issues? We ended up in a high single-digit return, even when we ran those stress tests of rental rates going down. We did not end up in a losing capital on this investment situation, hence our confidence in it. We don't find off-market deals every day that stabilize close to an 8 in Scottsdale, but when we do, we buy them. I think we hit the 5 that you mentioned, Pike. The only other thing we haven't really talked about is the exit. You want to walk us through the exit?
I'm happy to talk through it in terms of options and who our likely buyers are. If we're selling, the reason we like having multiple assets, it gives us a lot of flexibility. We could sell these 2 assets together as a stabilized portfolio. We're always looking at opportunity to do an aggregated roll-up strategy with the rest of our small bay portfolio and see if we can find an institution who's willing to pay a premium or a very much so compressed cap rate in order to get a large slug of assets or deploy a significant amount of capital in this asset class or in the submarket. And then the flexibility comes on if we wanted to sell them as one-off assets as well. We could even separate the 2 assets and sell them to smaller 1031 buyers. So from a sale or an exit, we've got a lot of optionality on who we sell to. Additionally, as Chris mentioned, the stabilized return on cost on these deals are extremely attractive. Heading into years 4 and 5, we're getting well into the 7s and exceeding an 8 return on cost as we continue to hold the assets and able to attack the rest of the rent roll. So if for any reason it's not an accretive market to sell or exit, then we'll look at holding these assets for a longer period of time. We're not going to force ourselves to sell in a down market.
Well said.
Brings us to the end. Looks like we got through all the audience questions. Hanson or Pike, is there anything you'd like to close on here?
Simple. Putting $2.5 million of the roughly $10 million in, that's a vote of confidence because simply a 97% leased day 1 cash flow deal in one of the most supply constrained submarkets in the country with a 65% lift is not something we've seen. We're not underwriting growth. We're just capturing what's already on the table and being achieved in the market today. And if that approach makes sense to you, we would love and welcome to have a conversation to see about you partnering with us. Really want to thank everybody for taking the time to join us today and learn about this Scottsdale investment. And we look forward to speaking to you soon.
Thanks, everybody.